All right, good evening, everybody. We will go ahead and get started. I want to thank you all for coming. Today we're going to be talking about using MQ market strength to place stops, and we'll also talk about a little bit about profit taking with the market strength and how you can do that. Now, I'm kind of going to switch it up a little bit. Normally, I put together a PowerPoint and run through a PowerPoint slide and presentation that way. Today, we're going to do it a little bit different. I figured it would be easier to just show you with real examples how to place your stop using the market strength instead of trying to put together a PowerPoint that doesn't quite showcase it as well, in my opinion. So what the market strength indicator does, it's very cool in my opinion. That's correct, Jack. Just so everyone knows, these webinars are for educational purposes only. We are not recommending that you take any trades based off of them, as we do not give specific trade advice. So it is, again, just for educational purposes only. I want to make that very clear. Now, back to what I was saying. What the MQ market strength does is it's very neat. It shows you basically the amount of a move that the market normally moves, meaning the blue lines are the average move for the rally, and the red lines are the average move for the sell. So buyers are blue, sellers are red. And if you go back and you look, you can see a lot of times the market will actually follow an average high. For example, with buyers here in crude oil, you can see the average rally was about $5 an ounce. And then again came back up, $5 an ounce. Then again, $5 an ounce. Then again, just below $5 an ounce. And again, just barely above $5 an ounce. So a lot of times you can go back and look at, historically speaking, just how far the average move in the market is, whether that be for buyers and sellers. Now, I forgot the gentleman's name, but in Market Wizards, I was reading the other day, and for those of you that were in the candlestick reversal course, you heard me talk about this as well. He was talking about stop placement, and he said when he places his stop, $5 a barrel, that's correct, Chris, sorry, I was saying an ounce, and mine was in gold. He said when placing a stop, your goal is to put the stop far enough away that if it gets hit, that you know that your trade idea was wrong. So meaning, if his stop is hit, he goes to bed knowing that as long as his stop isn't hit, then he's still okay with that trade. If it gets hit, then he knows he should have been out of it, his trade idea was wrong, and then he can move on with it. And by placing stops using the market strength, that's a very good way you can do it. And you can do this on any different time frame, whether you're trading off of a 5-minute chart, a daily, a weekly, etc. You can look at what the average move is. And what you're trying to do is pinpoint just how far the market normally will move. And if you look, especially while we were in this channel, you can see the average sells were just about $5 a barrel as well, multiple times. You can also use this to look for divergences, meaning higher high prices but lower high indicators. But that's a story for a different time. You can see here we had a nice bullish divergence where we had lower prices, but the indicator was higher. Again, higher here than it was, or lower here than it was there with lower prices. So the indicator was diverging a little bit instead of continuing to hit new lows or new highs with the market strength. We were hitting lower highs. But again, that's a story for a different time. Another way you can use this indicator, as I mentioned initially, is to have a profit target. So you're saying, okay, a lot of traders are asking, when do I get out? When do I get out? Well, it's very easy if you know what the average move is, or what you're supposed to expect, what you expect that market to move. So if you're expecting that market, say you're trading on a 5-minute time frame, you're trading crude, you expect, and you can see historically speaking, crude normally will move around 10, 15 cents a barrel off of a 5-minute time frame. So your profit target before reversing, so your profit target is going to be 10 or 15 cents. So you can go back and look at it that way. And I'll show you just how to do that here in 1 second. Now, for example, let's look at crude. We're looking here, crude on a daily basis is forming a bearish divergence. Okay, so if we wanted to get short here, we have a couple things in our favor already. You can see over the past few weeks, the average rally has been right about $3.35 before the sellers came back in and pushed prices a little bit lower. All right, then you can also see that the average sell-off during this uptrending period has been about $2.13 a barrel. All right, so you have your average buy is right about $3.30. Your average sell is right about $2.25, $2.13, right in that area. That's based off of 1, 2, 3 recent highs on your sells, and then 1, 2, 3 recent highs for your buyers. So in the past couple of weeks, we know that the average rally has lasted about $3 a barrel before having a counter trend move, and the average sell on that counter trend move has been about $2.13. Well, now we're coming back up. You can see where the market strength indicator is right now. We're up around $2.66. So technically speaking, we could get another 80 cents out a barrel to the upside. So if we were trying to short, what we could do is put our stop far enough away that if it is going to rally the same amount that it usually does, we would not be hit. So if it usually rallies about 88 cents more than where we are right now, or 80 cents more than where we are, we could put our stop 85 or 90 cents out. That's if you're doing a very long-term trade. I never would recommend to somebody to put a 90-cent stop in crude oil. That's very, very far off. But you can do the same thing in a shorter time frame. And then again, your target would be the average sell. So you can see the average sell is $2 a barrel, $2.15 a barrel. So it would be about $95, $95.30 or so to the downside. So that's where your profit target would be. So you'd be risking just beyond the average rally to try to catch the average sell. That's how you know you're getting close to the end of the rally, or you could potentially be getting close to the end of the rally, and it adds a little bit of credibility to your bearish divergence. Now, we can also do this, and like I said, we can drill down a little further intraday, and I'll show you some examples of using it on a 5 or a 10 or 15-minute chart. And you can use this on any market that you're trading with. The indicator works the same. We're just going to be using crude for an example for today. So let's go down. Let's look at a 30-minute chart. All right, with crude on a 30-minute basis, by the way, here's what I was talking about with using it as a divergence. You can put a trend line going down, and you can see each one of those highs right before it sold off again has retested that trend line. So you saw, okay, here's the first one, here's the second one. So the third one was right at the open, and then it sold off from there, just a few ticks, but that's all right. Again, what you're looking for is what the average rally versus the average sell is. And also you can go back and you can look at the time of day. So right in the middle of the day, you can see that the average rally is about $1.70 per barrel. You can also see that the average sell is right around $1.15 a barrel if it's going to sell off hard. Same for the rally. If it's going to rally hard, about $1.60, $1.70. If it's going to sell off hard, about $1.40 or $1.30. And again, all you're looking for is connecting these tops. What's the average high? So you can see that's the average from here, 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 and here. And then again for the sell or for the buyers, your high would be connecting this high, and this high. You can see that's about the average sell-off each time, or average rally each time. So what you can do is, if you're looking to short or looking to get out of that trade, you can say, all right, we've reached that average rally point of $1.70 or $1.60. I'm going to go ahead and close my position because it could be coming to an end. Let's say we were looking to get long. Down here you can see the average sell-off at the lows. If we condense this a little bit more, we could get a little bit more information out of it. Again, you're looking for the average sell-off. Look at how many tops came up right around $1 a barrel. So you had 1, 2, 3, 4, 5. This one's a little bit above. So you had roughly 6 highs that are all about $1 a barrel. So if you're looking to get long and you see, all right, this market has sold off, let's say 90 cents, you know that the average sell-off is $1 a barrel. So that means you have about 5 more cents to go before it gets reached. So what you would do is place your stop. If you're going long, you place your stop another 10 or 15 cents below that. That way you have the ability to say it should not, based off a historical price movement, go any further down than the current level. So your stop is far enough away that technically it should not get hit if your trade idea is correct. If you're wrong, then you will get hit, and then you'll know that your trade idea is wrong. So again, it goes back to that whole entire concept of you want to put your stop far enough away that it won't get hit unless your idea for the trade is off. Again, it's really simple. It's not that hard of a concept to grasp, but I want to show you a few more examples of how we could do this. Let's zoom in a bit. So let's say we're looking to buy. We see our average sell-off is around $1. If you want to go down and see, get the exact highs, meaning you're looking for the most highs that are connecting with it at one time, that's going to be roughly right here at about 60 cents a barrel, because you have one high there, 2, 3 highs, 4 highs, 5 highs, 6 highs, 7, 8. You can see the majority of them are about 60 cents. The exceptions are the ones that go up around $1. So the majority is about 60 cents. So let's say we're looking to get long. We can see we've sold off, then we have a bullish divergence here. And you can see, let's see, this sell-off has reached, by the time we have that bullish divergence, it's reached a level of 54 cents. So technically speaking, it shouldn't go much further than about 5 or 6 cents more than where it is. Now it ended up selling off a total of 69 cents, but again, that's why you're putting it 10 to 15 cents below or beyond what that high would have been. So if you're trying to get long on that bullish divergence, you actually had the bullish divergence here, and by the time you had the actual bullish divergence, you also had a reversal pattern on a 30-minute. You see you've gone just barely beyond what the average sell is, so you know that technically the market shouldn't go any further, so you can get long, placing your stop just beyond that. You can see the sell-off was 69 cents, where it says SELLSTRENGs for sell strength. So you know sellers typically sell at 60 cents. You've gone 69 cents, a little bit further than what it normally would be. You also have the bullish divergence. It adds credibility and allows you to go ahead and place your stop just below the lows, because you know that technically speaking, based off a historical price movement, it shouldn't go any further south than where it is. Does everybody understand that? I want to make sure everybody can get what I'm saying, understands what I'm saying. There's a vertical line. You can see on this price bar, we had the bullish divergence where we had lower prices, but a higher low on our indicator. And then if you look back and you saw the horizontal line, you said, okay, the average sell-off was 60 cents. So you knew that technically speaking, it should be rallying from here. Let me answer a couple of questions really quick. Are you using, in any circumstances, the value bar chart as a trend confirmation, as sometimes they become very quick, overbought or oversold? Are you saying if it jumps from here up to significantly overvalued, like it did right here in about 30 minutes, you had a price move of 95.65 all the way up to 96.30? Is that what you're saying? Am I saying, okay, the trend has now shifted up because that happened? You can sometimes say that. It's called a value migration when that occurs. What a value migration is when the markets move from what once would have been overvalued. It moves so far that it would have been overvalued from these prices down here, but since it's moved so far, what was once overvalued has now become the new fair value. And you can see that they adjust, your value bars quickly adjust right back into fair value instead of saying it's significantly overvalued. So yes, you can use it as a breakout confirmation sometimes that way. I don't typically trade that way, but that's one way of looking at it, looking for a value migration to trade in the direction of the migration. So that is entirely possible if you wanted to try to trade it that way. You are welcome. A lot of times that'll happen when a market gaps after earnings in the stock market. You'll have an earnings report, the market will gap, and then it'll jump from fair value straight up into significantly overvalued or significantly undervalued, and that's actually a value migration. It's not saying that you should be buying or selling off of there. And remember, with value charts, you're always looking to take it in context. What's the context that you're looking at? Here we were bullish, so we said we had a bullish bullish divergence. We were looking to be long, so we expected prices to jump. So we're not trying to sell it just because it hits significantly overvalued. Does the market strength have anything to do with the ATR? No, it does not. I do not believe. Don't quote me on that. No, I do not know what the actual algorithm is for the market strength. All right, let's look at another example. We're still bullish gold, or crude oil, excuse me, and we see, all right, this market has sold off right here. It sold off to the 60-cent sell-off point, and then again, it came right back up and retested that 60-cent sell-off point. So we can say, all right, it's reached that average sell, so the average down move, as you saw, and why we have that horizontal line going across is 60 cents. So that means we can be looking to buy, placing our stop a few cents below that. So we're looking to get long. Our stop's going just below that because we want it out of range of what the average sell would be. So we put it 10 to 15 cents below. So 10 to 15 ticks. And that would give us the room needed for this market to move in our direction as long as it's actually going to hold to what the average sell is. Average sell was, historically speaking. You can see both times it hit that point, you hit it right about there, it rallied straight up, and then again you hit it right here, it rallied straight up. So again, it helps you time your entries, and then if you had gotten in a little bit earlier, let's say you got in while this market had only sold off 53 cents or 55 cents. Well, you know the average sell-off is 60 cents, so again you could put your stop loss about 10 ticks below where you are, because it shouldn't technically go past the 60-cent sell-off mark. And again, that 60 cents comes from the highest number of highs are right about 60 cents on the 30-minute chart. You can see one top there, two. We had another one that was very close right there, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. You can see all those average highs are right at 60 cents. So all you really have to do is you keep your market strength indicator up. You put your lines in there for average sell. You can even label it if you want. Just put it in there. So we have our horizontal line. We have it labeled average sell. So whenever that market hits that average sell, as long as we have an undervalued price bar and we're trying to get long, so we have a bullish outlook, that means we have the okay to go ahead and get long and put our stop relatively close or a little bit further away, depending on where the average sell is and where the market is currently trading at. Does everybody understand what I mean by that? So again, it's just looking at historical price movement, and it's saying, historically speaking, the average has been about 60 cents for a sell. Now the same goes for a buy. If you were trying to take profits, let's say you were long, you go back and you look at, all right, what's the average rally? So let me fix this. Right here, we're going to say our average rally is about 73 cents. Let's condense this a little bit, double check, make sure. All right, yeah, your average rally is about 73 cents. You have a high here, 2 there, 1 there, 1 there. If you go back even more, you have another one. So our average rally is about 70 cents. So that way it means when you're looking to take profits, you're looking to take profits at around a 70-cent rally. So let's say you were long down here. You're looking to take profits at a rally of 70 cents. So let me erase these vertical lines and move one over so you can actually see where it's at when it hits 70 cents. Right there it hits 70 cents, so you're saying, okay, I'll go ahead and take profits. That's as far as the average move goes. Now it did end up going a little bit further than that. It ended up going a total of $1. That's all right. You left 30 cents on the table. That's completely fine. You're not looking to catch the entire trend. I mean, a lot of traders try to say, I got out at the very top or I got in at the very bottom. That doesn't happen all the time, and a lot of times you'll leave profits on the table. So you just took a 70-cent rally, and you know the odds are in your favor that you got out near the top. So it's a pretty good indication of when a market's going to be coming to an end and when you should be looking to take profits. I'll answer a few more questions. If you recall, Mark said the market strength measures the difference in the high or low of the current bar back X number of bars. Jack Like I said, I wish I knew. I don't remember what the algorithm is. I have a copy of it somewhere, but I don't remember what it is, to be honest with you. On Romulus, that goes to your question as well. I do not remember what the algorithm is and how it actually calculates the average rally versus the average sell. Lee, that's correct. So if you had two contracts on, you're looking for your profit taking right at around a 70 to 80 cent rally. You hit that, you could take off 1/2 profit and leave the other half with break even if you're trying to go longer. Or if you're trying to have a more aggressive approach, meaning you get out a little bit earlier, you'll take 1/2 off as soon as you get to the first rally, or as soon as you get halfway to your profit target, and then you take the other half off, or leave the other half on until you get to the full profit target. Now there are exceptions to rules, such as the huge rallies that are $1.70, $1.80. They don't happen very often, but you can see that the ones that did happen all happened right around the same high, so they all ended up being right around $1.70. I mean, this one back here was $1.40 or $1.64. This one here was $1.85, and this one here was $1.79. So you can see they're all right in that average area. So if you're getting a huge move like that, and the rally's really jumping, watch for it, because it'll, if you look back historically speaking, the average rally is about $1.70. So when you get up to that $1.70, if you're long, start being careful and start potentially looking to be exiting your position, because you could be coming to the end of that rally. And as you can see, a lot of times it'll rally all the way up and then fade off a little bit. Rally all the way up and it fades off a little bit. So keep that in mind. It's very simple. A lot of times traders look for extremely complex ways to trade because they think it works better if it's hard or if it's difficult to do. It's not necessarily true. I like the simple trades. Things like this, they just make sense. If the average rally is so far, why would you try to hold it longer than that? Or if the average sell is so far, you know you can put your stop just beyond what that average sell-off is, and you should technically be in good shape. So does anybody have any more questions on how this strategy works? Like I said, it's very simple. I know it didn't take very long to explain it, only about 20 minutes, which is completely fine. We try to keep these Tuesday night webinars only about 30 minutes long total as it is. So that's the strategy. Very easy. You look at what the average buy is versus what the average sell is, and then you look to place your stop loss just beyond what that average buy or sell is. Another thing I'll say too, along the lines of questions, tomorrow we're actually going to have just a Q&A session. That's tomorrow night at 9:30 p.m. Eastern Time. So that helps out you guys on the West Coast a little bit. And that's going to be Mark and I. We're just going to be sitting here, and all we'll do for about an hour or two is answer your questions. If you have a question that you want a guaranteed answer to, meaning you have to have an answer to this question or else you're going to die, or you just want to make sure that it does get answered, send an email into feedback@microquant.com. Again, that's feedback@microquant.com. I'll write it out right here. And we'll have a list of those tomorrow when we do the webinar tomorrow afternoon or tomorrow evening, Mark and I. And again, all we're going to be doing is answering your questions. So if you have questions on the indicators, or if you have questions on how the algorithms actually work, for those of you that were asking how market strength works, and I don't know what the algorithm is, Mark is the one that designed them. He is the guy to ask. He's the expert on what drives these indicators. Is there a video on how to set up on NinjaTrader? Chris, we do not have a video. There is a PDF document you can look at that gives you instructions on how to set everything up in NinjaTrader. You can get that if you go to valuecharts.com and then you go to the support tab. It'll be under product documentation. How do I personally use market strength on a daily basis? If you were in the trading room today, you saw I had it up on the dailies and the weeklies, and that helps me know, just like what we were talking about, when a trend is going to be coming to an end or when it's due for a drawdown. So if you're in the trading room, you see me use it on the dailies and the weeklies in that manner, so I know, okay, if I've had a bullish outlook for a while, it could be getting ready to come to an end here. or we could be nearing the end, or it still has a ways to go, that sort of thing. So that's how I use it on a daily basis. I do not normally place my stops off of it though, unless I'm within a few ticks. As you know, for those of you that are trading room, again, you know when I place my stop, I normally try to risk less than $200 a contract. And a lot of times, unless you're right up near the end of a rally or a sell-off point, which are oftentimes the best times to be getting in, you really would be using a little bit looser of a stop if you're judging it just off of market strength. In my current trading, am I using price action profile? And if yes, how? I do use price action profile occasionally. What it does is it shows you just how often a market trades in a specific value level. Meaning, if you pull up the price action profile, it'll say it trades in a value level of 4, which is moderately overvalued, X number of time, X percent of the time. So you know, okay, I got in at moderately overvalued. It only trades at or above this value level 20% of the time or 16% of the time. It also lets you judge just how good of an entry you have, basically, or what the chances are, the odds are of the market falling from the current level. That's how you use price action profile. Just gets a little bit, drills down and gets a little bit more specific on the exact percentages and that a market trades in a specific value level. Can I take a look at gold right now? Sure, I can take a look at gold right now, Lee. Gold's interesting. And the reason I say gold's interesting, I don't see a specific trade idea right now or trade opportunity right now personally. But if you look at the dailies, we have a yellow jacket doji that just formed. For those of you that were in the reversal course, you know that's a potential reversal pattern. So we'll see what ends up happening here. I think we also have a slight bullish divergence, -740 compared to -9.17. So yeah, we have a slight bullish divergence on our momentum as long as this market continues to head higher or stays here today, or tomorrow I should say. So we'll see how gold looks, but I'm pretty bullish gold right now off of this. It also couldn't stay below the weekly trend line. It broke down below it for a little bit today. As you can see, here is the weekly trend line we had drawn. Broke right down, hit moderately undervalued, to rally right back up. That tells me that the sellers weren't there to take it lower after it broke the trend line. So it just says there's not as many sellers. In my opinion, it shows that there's not as many sellers at this level. The gold yellow doji was Mark's newsletter item tonight. Oh, well, there you go. So, yeah, Mark's on the same page as I am with that potential reversal. It's not a perfect reversal pattern, but it is a potential reversal pattern. We could see higher prices from there. Same goes, by the way, for the British pound, if you want to see that. I'm bullish to pound again. We were long from the trading room earlier this morning. That was a great trade. But if you look here, we have a yellow tip doji right there with a bullish divergence. Again, lower prices, higher low indicator, great sign. And then it's the same thing that we went long off over here the other day. We went long here, covered and moderately overvalued because of the yellow tip doji. So now we have the same pattern again. The yellow tip doji, I'd like to see the pound rally up a bit. And again, the same goes with the pound. It broke the trend line, but it couldn't stay sold off. It broke through the weekly trend line. Let me draw that really quick so you can see what I'm talking about. When it breaks the trend line, you would have wanted to see it really take off to the downside because it's a pretty fairly obvious trend line. However, it didn't, which once again, similar to how gold is, shows me that the sellers just weren't there. You would have wanted to see the sellers just take over and start pushing it lower after it broke the trend line. However, the buyers came back and said, no, not quite, pushed it right back up above it. Can I look at gold with the market strength indicator? Absolutely. On which time frame are you trying to look at, Lee? A daily, you can see you came right up to where the average sell-off is actually today. If you look at it right around here you have highs 1, 2, 3, 4, 5, 6, 7. You can see a lot of the highs are right around $50 an ounce on the daily, and today we came right up to it. We sold off 47.50 and hit it, and now it's starting to roll over, which is again a good sign for bulls. You can see the average rally is a little bit higher than what this average sell-off is, so we should be looking for gold to rally about $68 an ounce according to the market strength. So we'll see, but again, you see it came right up to where that average high is based off of the historical highs, and now we'd like to see buyers come in and really start pushing prices higher. We will see. All right, if there's no more questions, then I'll go ahead and end today's webinar. Again, we try to keep these pretty short, about 30 minutes long. We want to respect your time. Once more, if you have a lot of questions that you want answered or more specific questions about the actual indicators, go to valuecharts.com and sign up for the Q&A session tomorrow at 9:30 p.m. Eastern Time. You can just, right there, if you go to valuecharts.com, right at the very home page on the right-hand side, there's a box. Enter your name and email to sign up for the Q&A. That's how you'll do that. So again, I want to thank everybody for coming. Hope you all enjoyed it. Hope you learned a little bit more about how to use the market strength and how to potentially set stops using that. And I will see most of you tomorrow morning in the trading room. We've been doing really well. We were back up again today. So we were down yesterday. That was our 4th down day in the past 13 weeks. So we were up again today. That sounds pretty good to me. I mean, pretty good track record in my opinion. Hopefully we will continue to head higher or continue to have up days. If you look here in gold as well, by the way, you were right on some support. I believe we pointed that out in the trading room today. Based off of these highs back here and these lows here and these lows here. You're right on that. You bounced off of it today. So, all right, look forward to seeing everyone in the trading room tomorrow, and if not in the trading room, then at the Q&A session where we can answer as many questions as you have. So thanks for coming. Hope everybody has a great night.